Welcome back, and we're joined by Rakesh Vyas, CIO and Portfolio Manager at Quest Investment Managers, this afternoon to try and get a sense of how he's viewing markets. Rakesh, let me first try and set the context. Obviously, there's just so much uncertainty we faced over the last 12 months or so. How do you see maybe the next 12 months in terms of how Indian markets will perform? Because we've sharply underperformed the rest of the world to a large extent. And mid caps and small caps have especially seen a lot of pain. So portfolios are in pain. When does that reverse? I'm trying to get a sense.
Having me on this show. You
Great
are
having
right.
you.
I mean, look at it, last 15 months actually has been far more challenging than what we have seen in last 4 5 years. But I think a large part of it is also to be blamed upon the very moderate kind of earnings growth that we saw in the market. And as valuations were reasonably fair to expensive in that context, and deceleration in the earnings growth is what led to the massive underperformance that you see compared to the other global indices. But as I see from here on, I mean, lot of the impetus being given by both the RBI and central government is trying to boost the consumption, and that's what seems to be picking up now. So if you look at even the credit growth data that RBI releases fortnightly, the last release does indicate that we are seeing almost close to 14% credit growth, which does suggest that the consumption seems to be coming back on track. And in that context, I think if you look at over next 4 to 5 quarters, there is very strong chance that the corporate earnings will revive back to its normalized numbers between 12 to 14%. And that being the case, then market return should also follow that trend. If you see now for all the results that have come so far for this quarter, we seems to be broadly in line with what the expectations normally were, adjusting for some of one-off related to labor code, etc. Which means that a large downgrade cycle that was continuing for last 5 6 quarters seems to have halted. And therefore, that gives us a confidence that as you move now incrementally into next 4 quarters or so, the earning revival should be reasonably strong. So we remain fairly more constructive on markets going into calendar year 26 already.
Okay. Rakesh, where within the mid cap, small cap versus large cap are you spotting opportunities? At least between these two cohorts, would mid cap, small cap be the preference?
Yeah, I think if you look at from next 4 to 6 quarters perspective, I still think a lot of opportunities starting to emerge in mid and small cap names. Some of the small caps are also impacted largely because earnings have been disappointing for them compared to what the expectations were. But as we move now going forward on a reasonably more, muted expectations, there is very strong likelihood that we'll see reasonable outperformance in earnings from small and mid cap. And that's an area of pocket where we should start to look more deeper into. However, I'll just caution as well that I don't expect there should be any massive re-rating of this space because multiples are already fairly reasonable. Therefore, the overall expectation of return should be commensurate with the earnings that we see from that space.
Hmm. Okay. And Rakesh, so therefore, where's the tilt with regard to sectors? There are clearly opportunities that you're seeing. Where are those opportunities most obvious in terms of maybe your top three, maybe sectors, subsectors, which are looking really good?
Yeah, great question, Harsh. I think if you look at our portfolio positioning today, I think we are fairly more tilted towards BFSI as a space, of which I think incrementally we have started to take reasonably meaningful position in the small and mid cap private bank space or NBFCs in general. And I think the capital market as a play continues to remain fairly strong, given that last 12 15 months have been far more challenging in terms of market return. Even then, we continue to see very strong inflows coming in for mutual funds. And I think as we start to expect a normalized kind of return profile from here on, the MTM gain and the continued inflows will continue to support capital marketplace. So within BFSI, I think these two are places where we are fairly more positive. I think over last 4 to 6 quarters, we have also been fairly positive on the consumer discretionary space. That's one of the bet that we have, especially given, as I highlighted, the RBI and central government interventions that happened with a focus on reviving consumption, and most probably consumer discretionary as a space will continue to do well. So our bets are there off in that space as well, with some of the platform companies also taking large share of our portfolio construct. So we remain fairly positive on autos, hospitality, real estate, and platform companies that I highlighted. And the last thing that I would probably talk about is also the power T&D space, because that's a space where we believe that not just in India but globally there is going to be a massive investment that will come through over next 4 to 5 years. And there are various plays both within the EPC construct as well as the equipment supplier where we have reasonably good position on. So these are the three larger themes that I will probably highlight too. And last one where we are more, uh, I would probably say selective, but starting to become far more benign about is basically the manufacturing space. Because I think as the demand continues to improve, the utilization levels of most industries will increase thereof, which has been a trend that was missing for last 3 4 years. And in that context, then you will probably see private capex coming through. At least the announcement will start in next 12 months or so.
Hmm. Okay. Uh, where within power would you play? So, where within the energy value chain uh, are you most positive, if I can ask you? Because there are just so many ways of playing the theme. One of them is obviously your power lenders. REC came out with numbers yesterday, very unenthusing set, to be honest, in terms of growth. Didn't come through, and I think the street is disappointed on the back of that. But some of the T&D numbers have been extremely strong. TD Power, GET&D. But again, cash flows there in that space sometimes becomes a concern. How should one play it?
So our exposure largely is more towards the transmission space, if I could classify it like that, both in terms of the equipment suppliers, especially around the HVDC and the high voltage transmission equipment suppliers, as well as some of the EPC players who will probably continue to play a major role in strengthening the grid largely. And I think our exposures to companies like Kalpataru and Techno Electric, Hitachi Energy has been towards that. And we continue to remain far more positive in that space because I think as the renewable continues to gain traction, we will need strengthening in the grid system. And that's a phenomena that not just exists in India but globally as well.
Hmm. Okay. Uh, Rakesh, just last take with regard to looking outward. Uh, Europe is emerging as a very, very interesting opportunity, especially for some of the textile players. Some of them are also beaten down, those who have more exposure to manufacturing out of India. And then you have India US, which is still in the pipeline, still in the works. What opportunities could both of those really unwind? And IT as well. Give us a sense of all export related sectors, spaces that look good to you.
You are right. I mean, Europe FTA is probably a very strong tailwind that will come through to many sectors, including the ones that you highlighted around textiles. But I will also nuance with the fact that the benefit of it will actually take some time for it to start accruing because there is still a lot of supply chain approval process that goes through, and then companies will also have to do meaningful capex to gain traction around that. But we also have to be kept in mind the US India trade deal because if that continues to get delayed, then there is still incremental capacity that is available with the textile manufacturers to move from US shipments to Europe. But largely, I think if we have a deal with US pretty soon, then a lot of export-oriented sectors will actually see a meaningful run-up because incrementally there seems to be more pressure on margins as well as sales velocity for those sectors. Coming to IT, I think that is one space where we have been uh, slightly unconstructive on for last almost 18 months or so. And I think valuations have also corrected meaningfully now. It has come to a level where at least the free cash flow and the dividend yields now provide reasonable support. But I would start to become more constructive on names where there is still strong visibility of growth and the valuation that you are paying is still reasonable and not very expensive. As I said, in many cases, valuations have corrected as well. But in the larger IT space, so to say, I think the corporate earning growth will probably lag the market earnings, and therefore I might be slightly more cautious there, but we'll continue to look at opportunities in mid and small IT space.
Okay, interesting. Rakesh, thank you so much for coming in and speaking with us. This has been a good one.
Thank you so much.
Right. Viewers, what we'll do is again dip into a very short break, mandatory one. We'll come back, we'll continue conversations on the other side of this very short break.